Good evening. Okay, can you hear me? Okay, good. So, today we are going to have the last two lectures for this course and for this module. So the first lecture will be like the finishing lecture for the bonds topic, and then we will switch to the equity topic. Usually I start the spring module with this lecture about the equity topic. However, so this year, the timetable and the schedule is kind of constraints because we have fewer hours than we used to have last year. So therefore, today we will first finish the bonds parts of the course and then start with the equity parts of the course with the second lecture. And today we are going to talk about duration and immunization. But as far as I remember, we still have topic on arbitrage unfinished. And as far as I remember, there was one slide left. So let me start with this. And then I probably will spend, I don't know, 5 or 10 minutes on this. And then I will switch to the immunization strategy. So now I need to open this presentation. Okay, so I switch on the demonstration. How can I do this? Okay, like that. Now I choose this file. Okay. So tell me please if you can see the presentation file. Okay. So let me remind you what we discussed last Friday, so just only 3 days ago. I hope you still remember something from the previous lecture, because I did not send you lecture notes. I decided just to finish and then to send you lecture notes in total. So I remind you that generally we were busy with proving one very important theorem in finance, and this theorem is called the equivalence theorem. So let me write it down. Equivalence theorem. So it states that if there is price inconsistency in the bonds markets, then there are no arbitrage opportunities, or vice versa, because this theorem works both ways. So vice versa, if there is no arbitrage, then it means that pricing is consistent in the bonds markets. Actually, we can prove it either way, either from the price consistency to the no arbitrage condition, or from the no arbitrage condition to price consistency. And recall once again that last time at the very beginning we already discussed this, that this is very understandable at an intuitive level. We discussed this example about a coupon bonds which is unfairly priced relative to the portfolio of discount bonds, of strips. And then we discussed what we could do in order to exploit these arbitrage opportunities. So if pricing is inconsistent, if there is a loss of connection between discount bonds markets and coupon bonds markets, then there are arbitrage opportunities. So now we're going to prove this officially, formally. And for this, so let me just highlight it. So this is our equivalence theorem. And I remind you that we finished somewhere at this slide. So here we have so the one which you the line which is highlighted in red. So this is our n-dimensional space, which represents all feasible portfolios. Feasible portfolios means that we can physically create them, because they all consist of coupon bonds which are traded actually traded in the market. So not just some imaginary coupon bonds, but only those bonds who are traded on the markets. And if there is just one bond which is traded in the markets, then you can take it either in a zero position, empty portfolio, in a long position, for example, point J, or in a short position, points K. So here we have minus. You can, for example, imagine that this is an axis also. So here we have minus, here we have plus, and then here we have an infinitudes of portfolios where we have long position with these coupon bonds, and here we have an infinitude of portfolios where we have short position. So if we want to add one more coupon bonds, assume that there are two coupon bonds which are traded on the markets, then we can actually just increase the number of the dimensions, and you know that all dimensions should be perpendicular to each other, so something like that. And therefore, sorry, I got disconnected. Tell me, please, do you see the presentation now? Okay. So, okay, I will start with this vertical axis. If we add one more coupon bond which is traded in the markets, then you can take either long position in it or short position in it, or if you go
Sorry,
some.
but we don't see presentation.
Say it once again.
Sorry, but we don't see your presentation. Your screen.
Okay. So you do not see my presentation. Okay. Okay, keep it. Right. Okay, so let me switch it on again. So now I think you should see it.
Yes, we see.
Good. Okay, I'll just repeat it for the third time now. So if you want to take a second coupon bonds in so long position, you will be somewhere here. If you take in a short position, you will be somewhere here. But finally, if you want to combine two coupon bonds in different positions, then you will be anywhere here. So as we increase the number of coupon bonds traded in the markets, then essentially we increase the number of dimensions. Therefore, again, this kinds of space, I call it here as H, as you can see. H means hyperplane. Hyperplane means that we do not deal with just two-dimensional plane, we deal with a higher order dimensional plane, which usually is called hyperplane. So this is a hyperplane because we really do not specify the number of dimensions, just n dimensions in total. So we have n dimensional and we have n dimensional plane or hyperplane. Anyway, so this plane describes portfolios from the point of view of how many units of each coupon bond is in this portfolio. For example, like 10 units, 50 units, 100 units, minus 100 units, and so something like that. So for example, let's look at these points and let's again assume that we, for example, have only two coupon bonds. So this is again a two-dimensional plane. So we have a positive amount of coupon bonds 1. We have a positive amount of coupon bonds 2. Therefore, this portfolio represents this point represents a portfolio from the point of view of how many units of each coupon bonds we have. We have long position in coupon bonds 1 and long position in coupon bond 2. And if you compare it to the plane which is to the left, this one, so recall that this plane, actually not the plane space, represents each portfolio from another perspective. With this space, we describe each portfolio from the point of view of what cash flows it has now and this is our vertical axis, and it will have in the future, and these are our two horizontal axes. Again, if we have many periods in the future, not just two periods in the future, but I don't know, just t periods in the future, and t, we do not specify t, it can be as large as we like, then in this case, we essentially have a t plus one dimensional space, because we always need to reserve one axis for current time. So this is our vertical axis. And then in this space, all portfolios will be described from the point of view of their current and future cash flows. Anyway, we are still talking about the same portfolios, and therefore, well, I mean, the same portfolios. I mean, we're still talking about portfolios which are created from the coupon bonds markets, and therefore we can just superimpose n-dimensional hyperplane to our t plus one dimensional space. So that's what I described last time, and I said that if you decrease the number of dimensions, you probably can imagine how it can be done in case of a plane and a cube. But anyway, again, we would like to generalize, so we have t plus one dimensional space and n-dimensional subspace or hyperplane. So therefore, the question is how we are going to, what will be the resulting picture? Where do we have this n-dimensional space? Whether one part of the space will overlap with our positive orphans. So this is our positive orphans. Here we have only positive positive cash flows in all three periods, and therefore here we have arbitrage portfolios. I think I have one more slide which can help you. So it's just in the same slides. So for example, if I take this line, well, I hope you can see the movements of the mouse now. So let's assume that we're again talking about just one dimensional plane or okay, one-dimensional space. Therefore, we have just only one coupon bond traded in the markets. So this is line. So this line can be, for example, positions like that. If it is positioned like that, then we see that all portfolios are actually arbitrage portfolios. So portfolios are both feasible. We can create them from coupon bonds which are traded in the markets, and at the same time they are arbitrage. So the question only is if it's possible that in the consistent markets, in the markets with consistent prices, we can have situations something like that, that is the parts of the feasible portfolios are located in the orphans which contains arbitrage portfolios. So these orphans represents the sets of arbitrage portfolios and our hyperplane. So this is our hyperplane, even though in this particular case, it is just one-dimensional plane, one-dimensional, I don't know, space. So the question is, if this is so, if this is not an empty set, then we have portfolios which are feasible. We can physically create them, but at the same time, they will be arbitrage portfolios. So the major question is if it is possible or not in the consistent markets. And now let me move to the next slide. Which way this will be the last slides for this lecture, and then in the slides I will show you that this is not possible, and by showing this we will just finish the proof of this basic equivalence theorem. So this is our question. There is, or actually this is our statement, there is no overlap between our hyperplane and the positive orphans. So we can either prove these statements from the point of view of consistent prices. So if the prices are consistent, there are no arbitrage. So this is just, so these statements will be true, this one, empty sets. Or we can prove these statements from the opposite way. We can say that if there is no arbitrage, then prices are consistent. So the second way is actually easier. So let's prove it from this second way. So we start from arbitrage, and then we show that if the arbitrage opportunities do not exist, then this means that prices are consistent, consistent prices. Okay, I'll just write it like that. And I remind you that what it means that we say we have consistent prices. Recall that consistent prices we actually have the definition of pricing consistency. So loosely speaking, pricing consistency means that we can draw this connection between discount bonds markets and coupon bonds markets, and we price coupon bonds using discounts vector. And so pricing consistency actually means that indeed we have this discounts vector. It is unique and it should be also positive. So recall that in the previous lecture we actually proved that it exists for the complete markets, but now we're going to prove it for the general case. We just have some number of coupon bonds, some number of periods. We do not specify that number of periods T is equal to the number of coupon bonds N, so we just don't specify this, but still we can prove that if there are no arbitrage opportunities, then we can find a single uniquely defined positive discounts vector. So in order to do this, let's outline the no arbitrage condition. So if this is our arbitrage condition, that is all our portfolios are located in the positive orphans, then logic suggests that no arbitrage means that our portfolios are outside the positive orphans. So this is our positive orphans. Here we have only arbitrage portfolios. Let me extend the axis like that. So therefore, portfolios which are located outside the positive orphans, outside the free lunch area, are our no arbitrage portfolios. And as far as I remember, we already discussed this portfolio. So for example, portfolio G, definitely it's no arbitrage portfolio because it will give you positive cash flow in the future, right? So here you will get some positive amounts of money. So tomorrow we have one period in the future using in this two-dimensional space. So you will have this portfolio will give you a positive amount of money in the future, but today your balance of cash is actually negative. Therefore, the price is positive. That is, in order to get this future positive amounts of money, now you pay for it, you give away money. So today you have negative, today you have cash outflow in order to get cash inflow tomorrow. And actually this is also a non-arbitrage portfolio, because in this case we have just a mirror reflection. So today so this is our today axis. So today your balance is positive, therefore you have negative price. That is, you form this portfolio in such a way that you stay with cash. However, tomorrow or one period in the future, your cash flow will be negative. Therefore, even though now you have cash, tomorrow you have to pay for it. So that is the most ordinary situation in a case when in your portfolio the value of short position exceeds the value of long position. So as I said previously, this kind of portfolio with a negative price is not something extraordinary. It's a quite ordinary thing. So I quite frequently have such kind of portfolio, but I have never found an arbitrage portfolio actually. But actually, I was not looking for it. But anyway, in this particular case, having this portfolio which gives you positive cash flow now is an ordinary thing. But then you should be prepared for having cash outflow tomorrow. So again, this is quite fair. So you pay tomorrow for something which you can get now. So this is fair, and this situation with J is also fair. So therefore, these are just, well, non-arbitrage portfolios. So here we have first quadrants, second quadrants, first quadrants, and fourth quadrants. So we discussed what occurs. We discussed portfolios in the first quadrants, in the second, and in the fourth quadrants. Tell me, please. So this is my question to you. How would you describe a holder? So here we also have portfolio in the first quadrants. Okay, so something like that. So tell me, please, how would you describe a holder of this portfolio? how would you describe this portfolio first of all, and then how would you describe the holder of this portfolio? So he pays now and receive loss in the future. Right, and so they pay for the bonds cash out today, and the bond defaults in the future. Well, that might also be, however, Zhao recall that we have never switched to the corporate bonds market, so we're talking about non-defaultable treasury government bonds. So this is our backbone, non-defaultable treasury bonds. So I think Ilya just describes the situation in a more correct way. So this is something like you have cash outflow today and tomorrow. So how would you describe the holder of this portfolio? So what would you say about someone who holds this kind of portfolio? Mm, well, for the future, right? So anyway, this person definitely is a total loser. But as long as we have portfolios here in the first orphans, there will be, I mean, these are not just some abstract portfolios, they have holders. So as long as there are holders of the portfolios in the free lunch area, then as a mirror reflection, there should be, and there are bound to be holders of these losing portfolios, so total losers. Winners and losers, just like a total situation. In total, we have something like the same amounts of money in the markets, and if someone gets money today and in the future, then it means that someone loses money today and in the future. So as simple as that. Okay, and the last part which we need to prove. So let's prove that the situation. So the situation means that we do not have arbitrage. So our feasible portfolios. So this line is our hyperplane. So I position this hyperplane in such a way that it's outside of the positive orphan. So all our feasible portfolios are non-arbitrage portfolios. It just only needed, well, the only thing which is left, the only thing which we need to prove now is that in these conditions, we can find uniquely defined positive discounts vector. So there will be a set of discounts prices less than one, which will be strictly positive. So in order to do this, we are going to employ the results of this theorem. It's called the hyperplane separation theorem. This is from high mathematics. We're not going to prove it, but actually it's not really difficult for understanding. So if you wish, you just can read about it. Well, probably you can find it in Wikipedia. Not sure, but probably. Anyway, so we're going only to use the results of this theorem, because we're going to apply the results of this theorem to our finance parts. And if we apply the results, then we will have something like that. So under this situation, so we have these kinds of no arbitrage situation. So in this situation, there will be one vector. So let me show this vector first of all. So let me denote this vector. Let me call it n, just like that, n. So this vector will contain t+1 elements, just as many axes we have in this space, as many dimensions we have in this space, as many elements our vector will obviously have. So it will have t+1 elements. I now enumerate only one element, but as for the rest elements, I just now denote the rest of the elements using just one vector. You already can see that this is actually our discount vector, so it will be, so our discount vector will have t elements, discounts prices from period 1 to period t. But now we actually need to show that indeed our vector will contain the discount vector and this element which is equal to 1. So in order to show this, we introduced two important properties of this vector. So once again, this is all the results of this hyperplane separation theorem. So we will have one vector under these conditions, and this vector will have two important properties. So let's look at these properties. So first of all, we have two vectors here. So this is our vector, which this one. Or anyway, this is a set of t+1 elements, and here we also have a vector or a set of t+1 elements, current price, and this recall that this is the donation for future cash flows, and we have t periods. Therefore, we have t future cash flows plus one element which represents current price. So also t+1 elements. And now this is actually something which is called dots products, or I don't know, scalar products, I think it's called also. So now recall, it's again about all vector products, vector multiplication. So we have something like a dot product. Tell me please, do you know how do we, or can you remember how do we calculate the dot products between the two vectors? So what we need to do? So dots because we have this, dots here. But another way is a scalar product, because as a result we get a scalar, not just another vector, but we get a scalar. And so how do we calculate it? What is app? Yeah, a product. Ну, asset inverse, умножение векторов, скалярное умножение. How do we conduct it, this kind of products? Okay, looks like you don't remember. Sum of products of each element. Well, all right, so that will be a kind of algebraic operation. So you take the first elements from the first vector, multiply by the first elements of the second vector, then you take the second elements of the first vector, multiply by the second elements of the second vector, and then you sum up. Or actually, this is correct, but this will not help you to understand the property of this vector. So we need to look from the geometric point of view. So recall that in order to get the scalar products, we take the absolute value of this vector, the absolute length or whatever. Then we take the length and the absolute value of this vector. So we take the length of the two vectors like that. And multiply by by what? And multiply by the cosine of the angle between them. So this is a geometric interpretation. So now tell me please, as a result, we are going to have 0. Obviously, these two vectors do not have 0 in their length in absolute values. Therefore, so multiplied by cosine, cosinus. So in this case, it means that in order to get 0, we need to have cosine equal to 0. Otherwise, we won't get 0. So tell me, please, when do we have cosine equal to 0? Right, exactly. So when the well, the slope, the angle, right, the angle is equal to 90 degrees. Therefore, so this is our feasible, this is our hyperplane, so our feasible portfolio, and therefore to this feasible portfolio we have a vector, so this vector, which in scalar multiplication will give us 0. Therefore, it is supposed to be located 90 degrees relative to this hyperplane. So let me draw it like that. So this looks like 90 degrees, right, like that. Okay, so now we probably understand why I call it n. N means normal, or in Russian we say normal. So we can say the normal vector or the orthogonal vector, orthogonальный vector. So this can also be said like that, and that is good because we have found this discount vector. So this is our discount vector plus 1 also. So this is our discount vector, which seems to be unique. Why so? Because, as you understand, there can be only one perpendicular line to any hyperplane. I mean, through the same points, you cannot draw as many perpendicular lines as you can, as you like, just simply because we always have only one perpendicular line. So therefore, this vector is unique. But what if this vector, but is the vector also should be positive, not just uniquely defined, but positive. But what if the set of discount prices is located not here, because here we obviously always have only positive values, but what if it goes here in the first quadrants? Here we have only minus, and therefore all our discount prices would be negative. So for this, we move to the second property of our vector. And the second property of this vector says that again, we have products, dot products, but this time this dot products says that the multiplication of our vector with any sets of, when any sets of cash flows which are located in the positive orphans should be more than 0. Again, obviously the length of each vector is given in absolute values, therefore it will be positive. And so we need to have cosine, which should be positive too. If it's negative, then we will not come to this condition that is going to be more than 0. So tell me please, when do we have cosine more than 0, positive? So you already told me that the cosine is equal to 0 when the angle is equal to 90 degrees, and cosine is positive if right. So essentially, we're not looking. Okay, minus 90 degrees means that we're somewhere here. So again, just watch the mouse. So, but we're not interested in this area because we're interested only in this normal vector. So our task, our objective is just to show that it's not located in the first quadrant. It is located in the first quadrants. Therefore, as you correctly say, we might look at something between 0 and 90 degrees. So we have an acute angle, and when the angle is acute, therefore we have a positive cosine. So therefore, this second condition says that our normal vector, our discount vector, actually forms an acute angle with any vector which is located in the positive orphans. So this angle will always be acute. So therefore, according to the second condition, our discount vector cannot be located in the first quadrants. It is located in the first quadrants. So all our discount prices are located in the first quadrants. And recall that in the first quadrants, we have only positive cash flows. Therefore, all x's are associated with positive amounts of money. So therefore, our discount vector is strictly positive. So with these two properties, we have proven that the discount vector is uniquely determined and it is positive. And therefore, we have proved that if we have a situation like that, so we do not have arbitrage opportunities, then the discount vector exists, and therefore we have pricing consistency. So essentially, this basic equivalence theorem works if prices are consistent, then there are no arbitrage opportunities, or the other way around. If there are no arbitrage opportunities, that means that prices are consistent. So this theorem is, as I said, so today my provider does not really work well. Okay. So tell me please if you now see the presentation. Good. So anyway, that's it for this lecture, the one which we started previously. So once again, our important basic equivalence theorem has been proven. Tell me please if you have any questions concerning this lecture, because if not, then we're going to move to the immunization strategy. So probably, do you have any questions concerning this slides particularly, because I know that the previous slides were from the previous lecture, so you probably can only now have questions concerning this slide. So why I didn't quite understand the first formula. What do I have it? Seems that
yeah, it's about the product. For the second element, just get them out and multiply them. We got the x in the sorry, for all minus p x. I just don't understand how do the vector multiplication.
So okay, if I understand correctly your question, so let's assume, for example, that we have just a very small, a few dimensions again in our situation. Okay, for example, 2 dimensions only, and so let me write it somewhere. I don't know, so something like that. So we have only 2 dimensions, means that we have only 2 elements in each vector. So the first elements I'm now talking about, for example, this one, and this is our second vector. So here we have 1, and a discount vector now consists only of 1 element because we have only two-dimensional space. So let it be, for example, it should be less than 1, obviously, because this is a discount price. So let it be 0.95. Now, so this is our orthogonal vector, or our discount vector plus 1, additional 1. Now, as for the second, so here we have some price. Oh, well, I don't know, specify this price. And then we have our future cash flow, which is going to be equal to, let's actually introduce one more so assume that we're talking about a three-dimensional space. So 2 periods in the future. So this is the first periods in the future, and this is gonna be second periods in the future. So for this, the discount price should be less than 0.95. So let it be 0.9, because its maturity is more distance than the maturity 1 year from now. So that's what we're going to be 2 years from now. So now we have just some coupon bonds whose price is now minus P, and then there will be some future cash flows X1 and X2, like that. So if you want to make a multiplication, that will be like something like that. Minus 1 multiplied by, minus 1 plus 1 multiplied by minus P plus discounts price right now, 1 period from now, multiplied by cash flow 1 period from now, plus discounts price for 2 periods multiplied by cash flow in 2 periods. So essentially, you take the first elements from the first vector, multiply by the first elements of the second vector. Then you take the second elements of the first vector, multiply by the second elements of the second vector, and then you take the third elements of the first vector and multiply by the third elements of the second vector. In our case, that all should be equal to 0 if we're talking about the first condition. And if you actually calculate it, if you try to solve for it, then you will get something like that. Price is equal to 0.95 multiplied by cash flow 1 period from now, plus 0.9 multiplied by cash flow 2 periods from now. Now, tell me please, does look like the formula for the bonds price, for the coupon bonds price?
Yes, clear. Thank you.
Okay. CT multiplied by DT. And then we sum up over T, but in our case, this is just equal to 2 periods. So once again, what you have here, what did I do? So what you have here in this axis, not in this axis, in these orphans, okay, in a two-dimensional space, that will be quadrants, but generally, if it's a T plus one-dimensional space, that will be an orphans. So this orphans is featured by only positive cash flows. So if the portfolio, if the coupon bonds portfolio is located here, then this is definitely an arbitrage portfolio. But the discount vector should be located here. So we do not expect an arbitrage portfolio, but we expect a discount vector to be located here, because discount vector assumes only positive cash flows. It is supposed to be featured only with positive elements, something like that. So, do you have any other questions? If you actually look at this, so let me just draw it a little bit larger, like that. So again, we're talking about two-dimensional space now, and this is our discounts vector. So then recall that it starts with 1. So here we have 1, and here we have D1. So discounts price for the maturity 1 periods from now. So that seems to be quite logical. So here the cash flow is equal to 1, and recall that this axis is actually the time period right now. So right now the discounts price is equal to 1, which is quite obvious. The discounts price for the bonds which matures right now is equal to 1, so 1 units of money. But this is our future periods, 1 periods in the future, and therefore in this case its price will be D1, which actually should be less than 1. I hope, I think the way how I draw it, it does look as if D1 is less than unity. So therefore, this is this part represents the amounts of money which you would pay right now for the cash flow, which will be received 1 period from the future, in the future. So that's it. So do you have any other questions? Okay, so looks like not. Okay, so then we will finish with this lecture. So I will stop the demonstration right now. And so let me now open another demonstration. So this is going to be about the immunization strategy. Okay, so this is the last topic, which is quite easy in my view, and actually it's definitely much easier than the previous one. The previous one was the most difficult. For the first half of the course, this is going to be easy. And today what we are going to do, we are going to employ our previous knowledge, the knowledge on duration, in order to construct one very important strategy in the bonds market. So you know that the major risk which occurs for treasury bonds is the price risk. So we're not talking about the default risk. Actually, we discussed the default risk in the very first lecture, but when we're talking about the treasury, both treasury bonds, we usually assume that the default risk is quite negligible, and therefore what we are most concerned about is the price risk. So recall that the price risk is the risk which arises from the movements of short-term interest rates in the future. So whatever will be the interest rates in the future, we don't know this right now, and therefore this uncertainty introduces price risk, that if interest rates go high, go up, then the price of the bonds goes down. This is because of the inverse relationship between the price risk, between the interest rates change and the price change, between the direction of these changes. Okay, so for this particular price risk, what is not desirable for us if that is that interest rates might go up. So let me just draw it like that. So interest rates must go up. So that's what we would like to avoid. The situation is poses a risk for us, which is called price risk, and therefore the upwards movement in interest rates does not seem to be favorable for us. Okay, what will happen if interest rates go down instead of they go up? In this case, the price risk, a negative change in the an unfavorable change in the bond's price does not seem to be occur simply because interest rates go down. However, we encounter another type of risk. This time we encounter investment risk. So recall, reinvestment risk was discussed by us. So in the first lecture, and then also in the first tutorial. So in case of investment risk, what we would like to avoid is a downwards movements in interest rates. So if interest rates go up, then we encounter price risk. That is if interest rates go up, then the price of bonds goes down. If interest rates go down, then we encounter another type of risk, of investment risk. So we don't really know which type of risk is more important. It actually depends on general moods in the market. It depends on whether we expect interest rates go up or go down. But anyway, whether they go up or they go down, we anyway encounter this or that type of risk. So what to do in this case? By the way, before we answer this question, let me say a couple of more things about reinvestment risk. So I think I have a demonstration here. All right, so this is an example of reinvestment risk because you all can calculate a change in the bond price if interest rates go up. So for this, you use duration, and actually that will be a part of your home assignments for the next time. So we discussed duration last 2 lectures ago. So if you want to understand by how much the bonds price goes down if interest rates go up, you can just assume that you use duration and then you calculate this change. However, how to understand what you lose if you encounter investment risk? So this is actually a little bit different. It's actually it is supposed that you have another methodology in order to calculate their investment risk. And now let's see how it can be calculated. So we're in the treasury bonds markets, and assume that we're talking about a non-callable bonds. Actually, recall that in the treasury coupon bonds markets, coupon bonds pay coupons, and then you need to reinvest coupons at the interest rate which is no less than the one which was prevalent when you purchased the coupon bonds. So if you are not able to invest coupons at this high interest rate, then you will lose on interest accrued on these coupons. So this is our first source of reinvestment risk. But actually, there is one more source of investment risk. This is the source is the call provision. For example, assume that you buy a treasury bonds which has a call provision. In this case, you might assume that your investment horizon is time to maturity, for example, 10 years. But then suddenly the government announces that it's gonna exercise the call option. So if it exercises the call option, then you have to sell the bonds to the governments prematurely, so before maturity, at the fixed price, and then you will be left with cash, and this cash will be released before the time to maturity, that is before your fixed investment horizon. So this is another source of reinvestment risk, because in this case you will have to think what to do with this cash and how to reinvest this cash for additional time. So that might occur. I mean, if this investment occurs at an unfavorable time, at an unfavorable unfavorable market conditions, then you will probably lose money. So again, this is another source of investment risk for treasury bonds markets, but we will not talk about it. So we assume that we hold only non-callable treasury bonds, and we only face this first. We face investment risk which comes only from this source, that you get coupons and you need to reinvest them. So this is our formula. Recall it's from lecture 2. So this is the yield-based formula. So we take each cash flow in the future, all our coupon payments, and this is our nominal value, so our face value repayments, and then we discount these payments using yield to maturity, not discount prices, but yield to maturity, and then we come to our price. So what we can do with this formula in order to see how reinvestment risk is realized, let's multiply both parts of this equation, so the left-hand side and the right-hand side. So we multiplied both parts of this equation by the largest denominator, and this is, so this one, this is our largest denominator. So we multiply it by 1 plus, so gross yields raised to the time to maturity. And if you do this, then you get something like that. So this is your rearranged equation. So we multiply the left-hand side and also we multiply the right-hand side. And for convenience, I decided just to remove the summation sign and just write the coupons as they are. So now I guess you can see where we can encounter investment risk. So this is what we have to the left-hand side is our future value. So you all recognize that this is how we calculate future value. So this future value, and now if you look at this equality sign, then you can see that in order to get this future value, you have to observe certain conditions. What conditions? So you hold your bonds to maturity, because this is what you are going to get at the very end. Then you also get the coupon, the last coupon at the very end. So you don't reinvest this coupon because it is received at the very end of the time of the investment horizon. So there is no just time for investments. Then the last but one coupon, that is the one which you receive in period T-1, should be reinvested at the yield to maturity, the same yield to maturity as we have here. So the yield to maturity, which was prevailing at the time of purchase. Then another coupon, which you receive at time T-2, that is 2 periods prior to maturity, should be also reinvested, but now at the same yields for 2 periods at the same yields. Again, the same which was prevailing at the purchase, at the time of the purchase of the bonds, and so on. So you come to the very first coupon, which was received in periods. So by the way, in periods 1, so 1 periods from now, I mean from the very beginning, and then these bonds should be invested for the all periods except for 1, because 1 period has passed already. And then this coupon also should be invested at the same yield to maturity. So what happens if at any time periods in the future, here, here, or here, for example, you are not able to invest at the same time to maturity? For example, at some periods in the future, interest rates drop, the general level of interest rates drop. So what happens in this case? Then you invest the rest of the coupons at the yields, some other yields, which is smaller than the initial yield to maturity, the one which was prevailing at the time of purchase. Therefore, the amount of money which you get on reinvestments becomes smaller, and therefore the whole summation which we have in the right-hand side also becomes smaller. That is, it is not equal to the left-hand side anymore. So once again, in order to get this future value, you need to reinvest each coupon from these coupon bonds at the yields or at the interest rate, which is equal to the yield to maturity, which was prevailing at the time of purchase. If not, then you won't be able to reach this face value. Therefore, the question is it really realistic to assume that you are able to invest all your coupons at the same interest rates, which is equal to the yield to maturity prevailing at the time of purchase? Well, definitely not, especially if we're talking about a long maturity bonds, more than 1 year, for example, or something like that. Then, so the longer the time horizon, the less uncertainty we have about the future evolution of short-term interest rates. Therefore, it is quite likely that interest rates changes, and then you won't be able to make these investments at the same interest rates. So now, if this happens, then it's quite obvious. Then you will not get this face value. You will get the face value which will be smaller than this, and therefore we have something which is called promised yield to maturity. So if you look at this formula, I think you are accustomed to call this yield simply yield to maturity. So yield to maturity. But in fact, among practitioners, it can be actually called promised yield to maturity. So promised yield to maturity. Promised because it will be promised to you only if you are able to make all coupon investments at the same interest rates. So promise does not mean that it's going to be executed in the same manner. Therefore, at the end of the investment horizon, you actually can calculate your realized yield to maturity. And your realized yield to maturity might be quite different from your promised yield to maturity simply because you are not able to make this the proper investments. Let's look at this numeric example. So we assume that somehow we're now in periods 0. We cannot just write this here. So anyway, and here we have 20-year investment horizon. So maturity occurs 20 years from now. And now we're okay, I cannot just write it here. Okay. So anyway, let's assume that the general level of interest rates is 8%. So let's denote interest rate as I. So the general level of interest rate is 8%. So you buy the par bonds at the par, meaning that this the current price of the bonds is the same as the par value, and the par value is 1,000. Therefore, right now you also pay 1,000. So, and then you simply wait for 20 years to the maturity of the bonds. So what will happen in 20 years? So first of all, you get the nominal value itself, 1,000. Now you also get coupons. So here I assume that coupons are paid once a year, and therefore in total you will get 20 coupons. And by the way, if the bonds is traded at par, it means that its coupon rate is also equal to 8%. So 8% means 80, I don't know, dollars, for example. And therefore, you get this amount of money together with 1,000 and all coupon payments will give you 2,600. Now, if you manage to reinvest each coupon at 8% interest rates, or this 8% interest rates, then in total you will have 3 sources of income. Nominal value, all coupon payments, and plus reinvested on all coupons, that is, or all coupons reinvested. In total, in this case, you actually will get something about 4,661. So can you imagine, relative to the nominal value, which is equal to 1,000, the major income comes actually not from the nominal value repayments, but from the coupon and coupon reinvested. Now, assume that 2 years from, so somewhere here, 2 years from the purchase, interest rates suddenly go down unexpectedly, in a sense that that was not projected before. And so interest rates go from the general level, drops from 8% to 4%. And therefore, you cannot reinvest anymore your coupons at 8%. So you managed to invest your first 2 coupons at 8%, but then the rest of the coupons will be reinvested at 4% interest rates. So what happens in this case? If you recalculate all this, you'll see that the amount of money which you can get on reinvested coupons drops, and the total value of your investment drops to 3,717. So the difference here is about, well, about 1,000. So as you can see, just a mere drop in interest rates, a mere inability to reinvest coupons at the interest rates prevailing at the time of purchase means that your realized terminal value will be smaller by about 1,000, and your yield to maturity, which was initially projected at 8%, this is actually your promised yield to maturity, it turns to 5.12%, which is going to be your realized time to maturity. So this is the example where investment risk is realized. And here you could actually look at this expression, high yield illusion. This expression is quite frequently used among practitioners. It means, or it is used to label a situation when, for example, an investor buys a coupon bond at the time of high interest rates, and he says something like that: I have locked in high yields, simply because he has bought bonds at a high interest rates. Well, in fact, he or she has not locked in high yields, simply because in order to maintain these high yields, he or she needs to invest at the same high yields, which is just not possible, because if the investments was initiated at the time of high interest rates, then it is more likely that in the future interest rates go down, simply because interest rates cannot stay high for a long period of time, just due to economic forces. They will be pushed down due to something which is called mean reversion. So interest rates tend to exhibit mean reversion, in Russian возвращение к среднему, mean reversion, which means that if interest rates are too high, then they are more okay. Так, демонстрация экрана. Okay, shall I continue? Can you hear me? Good. So mean reversion means that if interest rates are at a very high level, then they will be pushed down by this, most likely by the actions of the central bank. And if they are too low, again, they will be pushed up by the actions of the central banks. Therefore, interest rates exhibits mean reversion, something like, they usually go like that, and then they always tend to revert to some long-term value. Therefore, if you buy bonds somewhere at this point, at the points of high interest rates, you are more likely won't be able to invest your coupons at the same high interest rates, because interest rates are more likely to go down. So therefore, you invest coupons at a lower interest rates, and therefore this yield to maturity, which you have at the very beginning of the purchase, is simply your promised yields, which will not be realized. So sometimes your investment risk might result in a big loss, in a sense that you projected one terminal value, but there will be quite a smaller terminal value. So let me now move back to this question. So what to do? If interest rates go up, you encounter price risk. If interest rates go down, you encounter reinvestment risk. So it seems that you just don't want that interest rates go either up or go down, because neither movement is really good for you. In any way, whatever direction interest rates change, you will always face risk, either price risk or reinvestment risk. So what to do in this case? Well, so essentially, let's agree that you just cannot control interest rates, especially future interest rates, meaning that you can make some predictions about what interest rates will, what path interest rates will take in the future, but these are only your predictions. So you cannot control interest rates, you cannot reduce the volatility of interest rates. Therefore, this is something beyond our control. But what we can do, so we cannot reduce the volatility of interest rates, but what we can do, what is within our control, we can reduce the sensitivity of our portfolio to the volatility of interest rates. So even though interest rates stay volatile or directional, even if they go up or go down, we can create a bonds portfolio in such a way that our portfolio will be less sensitive to the changes in interest rates. So another way, we can create our portfolio in such a way as to reduce exposure. Exposure is the same as sensitivity. So reduce exposure to interest rate changes or fluctuations in the future. So we create a portfolio in such a way that whatever path interest rates will take in the future, our portfolio will give us the same terminal value as we initially projected. So in order to do this, we apply the immunization strategy. And the immunization strategy actually is a very popular strategy. Therefore, if you, for example, if you are having an interview, if you apply for the position of bonds analyst or bonds manager or something like that, and you may be asked a question, what kind of strategies, bond strategies you know, you can always say that you know the immunization strategy because that will always work. So this is one of the most popular strategy. So immunization, again, this actually means that we try to immunize our portfolio against movements in interest rates. So our portfolio will be immune to these movements, or it will be non-sensitive to these movements. Oops. So what to do in order to create this kind of strategy? So what we should do with our bonds portfolio? So let me see how much time we have right now. Okay, we still have 5 more minutes. So in order to create an immunized portfolio, we need to deal with duration. So recall that duration was covered in lecture 4, I think. And in that lecture, we studied 3 types of duration: dollar duration, modified duration, and Macaulay duration. So I hope you still remember these things about duration. So today we are going to employ the notions of duration in order to create an immunized portfolio. These formulas are given for you here because I guess you probably don't remember these formulas. So this is our modified duration, a change in price in percents or relative change in price relative to a change in the yields in absolute values, that is in percentage points. And Macaulay duration is a change in price, again in percents, that is a relative change in the price, but this time we measure it against the change in gross yields in percents. And once again, looking at this formula and at this formula, you can see that the only difference between them is that here we also have this additional term, gross yields. Therefore, we can connect modified duration and Macaulay duration using this formula. So simply Macaulay duration is equal to modified duration multiplied by the gross yields. So for our immunized portfolio, we are going to use Macaulay duration, this one. And however, we are going to employ the knowledge of modified duration also. It will be needed for us. However, the basis of the immunization strategy is Macaulay duration. Now, the formula which are given to you here, these formulas are given to calculate Macaulay duration or modified duration for individual bonds or for one bonds. However, we have a portfolio, so it's not necessarily that our portfolio consists of one bonds only. It's possible that we have several bonds in the portfolio. So how to immunize our portfolio, how to deal with duration of a bonds portfolio. For this, we first of all need to give a definition of the duration of the bonds portfolio. So if we have a portfolio of bonds, then its duration is simply a weighted average of individual durations. That is, a weighted average of durations of individual securities within this portfolio. So I think I talked about this in the previous lecture. I covered this question because there was a question about this and I answered this. But anyway, let me just specify it once again. If we have a portfolio of several bonds, and if we want to calculate the Macaulay duration of this portfolio, then we simply calculate the Macaulay duration of each individual bonds in this portfolio and then calculate a weighted average. And the weights here is simply the cash flow which is associated with these bonds. Therefore, cash flow means the current price. So we take the value of each bonds or the price of each bonds in our portfolio, and then this value should be given in relative form, that is value of the bonds 1 relative to the value of the whole portfolio. Then that will be weights 1. Then value of the bonds 2 relative to the value of the whole portfolio, that will be weights 2, etc. So this is how we calculate the duration of the whole portfolio. Now let's move further, or actually let me see how much time we have now. Okay, in my cell phone I can see that we have 1 minute, but I guess in this case I will not go to the next slides. So let's stop here. Yeah, I guess let's stop here. So we're going to have a break, and then I will continue, and then I will see if we have more time to start the second half of the course today, or probably not. So anyway, let me check it when I finish this lecture. So now I pause the demonstration, and we have 10 minutes for a break. So, shall we continue? Yes, we shall. So, tell me please, do you have any questions concerning this slide, or shall we move further? Okay, so it seems that it's always clear. Okay. So once again, our objective is to create a portfolio in such a way that whatever interest rates will be in the future, our portfolio will be insensitive to these movements. Therefore, we will get the terminal value which we initially project for our portfolio. In order to do this, this portfolio is called immunized portfolio. So we're going to employ the immunization strategy. And in order to immunize our portfolio against movements in interest rates, we are going to manipulate with its duration. And as given here, the duration of the portfolio can be calculated as a weighted average of durations of individual bonds in our portfolio. So what to do with this duration? Let's move to the next slide. So this is the next slide. So you simply need to create your portfolio in such a way that the duration, the Macaulay duration of your portfolio should be equal to the term to maturity. Well, actually, it's not even the term to maturity because this is very restrictive. No one requires you to hold your bonds up to maturity. Actually, it can be any holding periods. So let's make sure you write its holding periods to the end, to the length of the holding periods. Well, holding periods or investment horizon. So, for example, you hold a portfolio, you plan to hold a portfolio for 5 years. It does not mean that necessarily your bonds will mature in 5 years, probably not, but in 5 years you are going to liquidate your portfolio, then you sell your bonds, and then 5 years is your investment horizon or your holding periods. In this case, you need to construct your portfolio in such a way as to have Macaulay duration of this portfolio to be equal to 5. So precisely 5, just like the length of the holding periods. Now, so let me see what we have here further. So the problem is that why this will work actually, and then we will discuss this a little bit, and then we will see how it works in practice. So, and by the way, as well, any strategy, any coupon bond strategy or any strategy in the bonds markets is based on certain assumptions. Unfortunately, there is nothing to be done about it. Ideally, would like to remove these assumptions because the markets, the live markets, the real markets might actually deviate from assumptions, but there is nothing to be done. I don't know a single strategy in the bond markets which wouldn't be based on certain set of assumptions, which sometimes may be not quite realistic. In our case, there are two assumptions for the immunization strategy to work. And the first assumption is that we have parallel shifts. Well, I will describe it right now. And the second assumption is actually, which is probably less restrictive, but still I should add it. The second assumption is that we have a flat term structure. Flat term structure or flat yield curve. Term structure or flat yield curve. So as for the flat yield curve, we already discussed this kind of case. So if we have dependency on the yield to maturity upon the time to maturity, then flat yield curve will be something like that. So we just have a flat line. Now, parallel shifts in the term structure or in the yield curve means that, so what we are struggling against? We're struggling against the vulnerability of our portfolio to a shift in interest rates in the future, which is unexpected. And the shifts might actually be quite different in the sense that, for example, assume that that's this particular flat yield curve we observed today. What if tomorrow unexpectedly the general level of interest rates goes up? So for example, here we have the general level of interest rates equal to 4%. And then tomorrow unexpectedly the level of interest rates goes up by, I don't know, well, also by 4%. And then we have a parallel shift, so that's going to be equal to 8% in this case. So like that. And then we have just a parallel shift in the sense that for each maturity, for each length of time to maturity, we have the same parallel shift, the same shift, meaning that we have the parallel shifts. However, the thing is that this is, well, this usually occurs most frequently, but not necessarily so like always like that, in the sense that sometimes the shifts might be non-parallel. So for example, it might be like that. So assume, for example, that we have ascending or normal yield curve, and then the parallel shifts would mean that tomorrow would mean that we have something like that. That will be parallel shifts upwards, that will be parallel shifts downwards. But a non-parallel shifts, that is for all length of maturities, we have the same shift, the same in absolute value. But the non-parallel shifts would be something like, I don't know, for example, it decreases at the short ends, increases at the long ends, and again decreases at the, well, actually it decreases at the short ends, increases in the medium parts, and decreases in the long ends. So that today my provider has decided to beat the records on the frequency of in gaps in connections. So совместное использование. Okay, so I was talking about the non-parallel shift. So in this case, for example, this is a non-parallel shift that is for different maturities. We might have different amounts by which interest rates go up or go down. So this is a non-parallel shift. Well, unfortunately, as I said previously, all bond strategies should be based on certain kinds of assumptions, and there's nothing to be done about this. However, in real life, we might lose these assumptions and see what happens to these strategies. So anyway, ideally, our immunization strategy should work in these two assumptions. We have parallel shifts in interest rates, and we have so this is one. And this is the second assumption, that we have flat term structure. So assume that you buy a bonds portfolio and hold it over your holding periods, and then suddenly in the future interest rates go up. So what happens to your to the price or to the value of your bonds portfolio? Well, obviously the price of coupon bonds go down because interest rates go up. Therefore, at the time of liquidation of your portfolio, you are supposed to lose on the prices of bonds. But at the same time, if interest rates go up, you are able to invest coupons at a higher interest rates. So at the end of your holding periods, you will actually get more on coupon investments than you initially projected. Therefore, you lose on bonds price, but you gain on coupon reinvestments. Okay, so this seems that there is both good effects of the bonds or of interest rates going up and bad effects. So good effects means that you have more on coupon reinvestments. Bad effects is that you have a loss in the bonds price. So that's what happens if interest rates rise. If interest rates drop, what will happen in this case? In this case, at the time of liquidation, you have higher prices for your bonds because of this inverse relationship, which is a good effect or a good consequence of a change in interest rates. But if interest rates drop, then you actually lose on coupon reinvestments because you are not able to invest at the previously rather high interest rates. So therefore, you lose on coupon reinvestments, but you gain on a price change. Again, you have a good effect and a bad effect. So it seems that in both cases, if interest rates go up or if interest rates go down, you always encounter two contradictory effects. One effect is positive, the other effect is negative. So with one effect you gain, with the other effect you lose. So now by intuition you already can guess that what we're trying to do using immunization, you're trying to balance off these two effects. We're trying to set our portfolio in such a way as the good effects in value precisely counterbalance bad effects and vice versa. If we manage to set our portfolio in such a way as that the good effects is completely compensates bad effects, or the bad effects is completely offset by the good effects, then in this case our portfolio will end up with the same terminal value as we projected initially. That is, no changes in interest rates will influence the value of our portfolio at the end of the holding periods. So therefore, what we want to do, we simply want to strike a balance between the good and the bad effects. And then in order to do this, we simply need to set Macaulay duration of our portfolio to be equal to the holding periods, length of the holding periods of our portfolio. Once again, as I said previously, if, for example, your holding period is 5 years, then you need to structure your bonds portfolio in such a way as the Macaulay duration of the whole portfolio is equal to 5 years. So now let's see how it works. So here we have a little bit of math, but I guess this is beyond the scope of the course, so we can actually skip this math and look at the example. Okay, so this is our example, and then we will see, using this example, we'll see how it works in practice, in the sense that we will see that if our portfolio is immunized, then indeed, whether interest rates go up or down, it doesn't matter, because in any way we will get the same terminal value. So assume that you have you work in a company, and your company is facing a liability, and this liability will occur, let's assume 3.7 years from now. So 3.7 years from now, your company has to will have a liability cash outflow at the amount of $100 million. So it means that 3.7 years from now, your company must have these amounts of money. But now, 3.7 years backwards, we actually, or your company has certain amounts of investments, which can be certain amounts of money, which can be invested for this period, so that at the end, we would get this 100 million. So we're going to invest our money into the bonds portfolio in such a way that at the end we would get precisely 100. So we assume that interest rate now is 5.5%. So this is our prevailing general level of interest rates. The amount of money, the terminal value which you would like to have in 3.7 years, is equal to $100 million. And now, so what you are going to do, you are going to make an investment into a coupon bonds. In 3.7 years, you are going to liquidate your investments, you are going to liquidate your portfolio, but the bond itself will mature 4 years from now. So there are no bonds which will mature precisely 3.7 years from now, which is quite a frequent situation, because quite frequently you cannot find a bond with the same maturity. So your holding period is 3.7 years, but the time to maturity for the coupon bond is going to be equal to the 4-year period. So therefore, in 3.7 years, you will simply sell the bonds. and you need to have 100 million as a terminal value. And the problem is that you really don't know whether interest rates will be the same in the future or not. So right now, interest rates are 5.5%, but you really don't know what will happen within this 3.7-year period. If interest rates stay the same, it's always fine. You will come to 100 million. But if not, then the question is, what will happen to your terminal value? Will you be able to get the same 100 million or not? So first of all, let's see, let's make sure that indeed you will get 100 million in 3.7 years if interest rates stay unchanged. And then we will see what will happen if interest rates actually changes. So if interest rates go down to 5% or go up to 6%. That is, there is a delta, a change in interest rates, which is equal to the plus or minus 0.5 percentage points. So let's first of all construct our portfolio. We can go to the market and we can observe prices in the market. And now we see that our bonds, which matures 4 years from now, its current price is this one, 1017. So recall that the face value of the bonds in the USD is usually 1000. Therefore, right now we can say that the bonds is traded at a premium. So it's more than 1000. It's by $70 more than 1000. Now, so what else? So this bonds has time to maturity equal to 4 years. So it will mature 4 years from now. And its coupon, well, it's given here, but I'll just write it once again. Its coupon is equal to 6%. So coupon rate is equal to 6%. And now tell me, please, so I asked this question here. So under these conditions that the coupon rate is equal to 6%, we see that the market price of the bonds, the current market price of the bonds is actually larger than the par value. That is, the par value is 1000, and therefore the bonds is traded at a premium. So tell me, please, why do we expect actually that the bonds will be indeed trading at a premium under such conditions? And this is my question to you. Well, we use this formula. So the one which is given in lecture notes. So we have 1000 nominal value, which we discount using our yield to maturity, which is 5.5%. So this is our general level of interest rates. 0.55. So do not forget to raise to power 4 because we are going to have 4 years to maturity, and then also we discount in the same way all coupon payments. So our coupon is equal to 6%. So therefore that's going to be equal to $60 relative to 1000, and then we also discount it using the same interest rate. So plus 0.55. So this formula is our yields-based formula, which was discussed in lecture 2. Okay, also raised to certain power. So right, premium bonds simply because indeed we see that yield to maturity is more than market rates. So what is market rates? Okay, then what is yield to maturity? So if market rate is 5.5%, then what is yield to maturity? So yield to maturity is more than market rate. So yield to maturity is more than 5.5. years of 5.5%. And then how do you understand that yield to maturity is larger? So Zhao, this is my question to you. What is then yield to maturity?
My understanding is because the YTM is bigger than market rate, so everyone would like this bond, so the price would goes up. So the bond price looks like premium.
Well, do you guys remember this table in lecture 3, I think, where I said some okay, so 6%. Well, no, yield to maturity is actually 5.5% because the bonds are usually supposed to be traded at the interest rates which corresponds to the prevailing interest rates. It will be highly unlikely that the bonds has interest rates. Well, can you imagine, for example, right now at the time of very low interest rates, can you imagine a bond whose yield to maturity is, I don't know, 15%? No, that's just doesn't work. Bonds prices in this case, the bonds price would go up, and then the yield to maturity would go in line with the prevailing market interest rate. So when I say the general level of interest rate is equal to 5.5%, so this is the yield to maturity. So now, what do you need to compare this yield to maturity to in order to understand that the bond is traded at a premium indeed? So recall this discussion about two sources of income for the coupon bonds: coupon payments and price appreciation. So the coupon is equal to 6%. The coupon rate is equal to 6%. So the prevailing market interest rate is 5.5%. So this is too good for the coupon bonds for this particular coupon bonds to provide you with a 6% of income. So no, yield to maturity is no. So this is really that will be well kind of unfair for this bond to provide you with 6% income if it's traded at par, because in this case you would indeed have assumed that it would be traded at 1,000 at par. In this case, indeed your income would be equal to 6% precisely, and then that will be something like, you know, too good to be true for the market environments when the prevailing interest rate is only 5.5%. That will be just unfair. So that bonds would be in higher demands. So everyone would like to buy these bonds. Well, okay, let me finish. So everyone would be likely would prefer to buy these bonds, and in this case, the price would go up until this particular point. That will be an equilibrium point, 1017, and then with this premium, if you buy the bonds with this premium, it means that even though you get coupon equal to 6%, you lose on price appreciation. That is the second source of income is going to be negative, because at the end you will get 1,000, so there will be price depreciation, and therefore the 6% of coupon income will be in fact offset by price depreciation, and in general yields for these bonds will be less than 6%. So now the question is, but so I hope you understand this. So, but it is stated that an annual coupon. So how is it possible? Well, why do you think this is not possible? So, do you know, for example, I can issue bonds and I can state any coupon I like. So, for example, if we're talking about junk bonds, well, or high yield bonds, мусорные облигации, then you know that their interest rates, their coupon rates are usually much higher than the prevailing interest rates, simply because otherwise no one would buy them. So then, for example, I don't know, it can be if the interest rates, prevailing interest rate for 3 years right now, for example, is 5%, then the high yield bonds would give you something about 8% or 9% or even, I don't know, 12%. So this is quite possible. Okay. So when we talk about market rates, if we were talking about market rates, this is something like we need to be guided by in order to understand what's going to be the yield to maturity, not the coupon rates, because the coupon rate is just a fixed amount which is issued, which is given at the time of issue. It cannot be changed unless it's initially provided that it's going to be variable, but usually it's fixed. So the only way for the bonds to provide you with adequate return, with the return which is compatible with the prevailing market interest rates, is just to set the yields to be equal to the prevailing interest rate. So the yield to maturity is 5.5. So do you understand this? Okay. So once again, the coupon rate is too high compared to the prevailing yield to maturity and prevailing interest rate. Therefore, the price will be larger in order to make the yield to maturity to be equal to 5.5%. So the bonds is traded at a premium. Now, you can calculate its Macaulay duration just using the formula which is given in lecture notes. And if you do this, then you will get 3 points something, which in short will be 3.7. So let's assume that it's approximately 3 points, well, 7 years, even though this is mathematically incorrect. It's going to be 3.8, but anyway, let's assume that this is going to be 3.7, and this is precisely equal to the length of the holding period, so which is also 3.7 years. So it seems that if we invest our money into these particular bonds with this feature, with this particular duration, then we achieve this important condition that the Macaulay duration of our portfolio is equal to the length of the holding periods. In our particular case, our portfolio consists of only 1 coupon bonds, but if it consisted of 2 coupon bonds, for example, then you would have to find a weighted average Macaulay duration. That will be your home assignment. Anyway, let's continue. So, since Macaulay duration is the same, then the only question which is left is how many coupon bonds we need to buy into our portfolio to get 100 million in the future. So that's what we are going to get in the future. Therefore, we can actually calculate how much money we need to invest right now. So we just use this present value concepts, and again we use this interest rates, the prevailing level of interest rates, because right now we have no we assume that that's going to be stable, so it will not change. So in this case, that's the amounts which we need to invest now, and let's calculate how many coupon bonds we can buy using this amount of money. We know that the face value of each coupon bonds is equal to 1,000, and we know that the current price is equal to 1,017. So in order to understand how many coupon bonds we are going to take into our portfolio, we simply divide total amounts by the current price. So this is our current price, and that's what we get. Okay, obviously in real life you would have to average this number because you cannot buy a fraction of the bonds. So in this case, you would probably buy 80,719 bonds. But let's continue like that. So let's assume that you can have the situation like that. So these amounts of bonds, so 80,718 bonds, and therefore the total face value which they will give you. So we'll simply multiply by 1,000 because 1 bond will give you 1,000 face value. So in total, the face value of these bonds is going to be equal to this amount. So let's try to recall this amount because we're going to use it in the next slide. So this is the face value of our investments. Okay, and I remind you that our aim is to get 100 million, so do not be confused here. This is the face value, that is what you will get at maturity, so this amounts, but what we want to get in 3.7 years is going to be equal to precisely 100 million, simply because in addition to face value, we actually have coupons and coupon reinvestments. So let's see how we can calculate it. So well, this is a little bit more complicated because we're talking about periods which is equal to 3.7 years. So not 3 years, not 4 years, but 3.7 years, somewhere between 3 and 4 years. So then the question is how to calculate our terminal value as of 3.7 years from now. So in order to do this, let's make it a little bit simpler. And first of all, let's calculate what we will get in 3 years. So we will just make a double step calculation. First, so this is where we are now, t equal to 0. And then we first calculate what we'll have in 3 years from now. So t equal to 3 years. And then we will just take this amount of money, which we will get 3 years from now, and drag it forward to 3.7 years from now. So that will be easier. Just because in this case, at least at this moment, at these periods, we will use a non-fractional period. So that will be easier for us. So at the end of year 3 or 3 years from now, what we have? First of all, we will have coupons. So one coupon will be received. Okay. So one coupon will be received 1 year from now. The other coupon will be received 2 years from now. And then one more coupon will be received 3 years from now. Recall that there will be also the last coupon, which will be received 4 years from now. But our investment period is 3.7 years. So the last coupon cannot be counted. So we only count the first coupon, the second coupon, and the third coupon. So we have the first coupon and we need to reinvest it. So this coupon is reinvested for 2 years, that is for one period, and for the second period for 2 years. Then you get the second coupon at the end of 2 years, and you also reinvest it, but now for 1 period, so for 1 year only. And then at the end of year 3, you get the last coupon. Well, relative to your holding periods, you will get the last coupon. You do not reinvest it because that's it. Then we will just count in different way. So let's calculate it. You have 6% coupon, so therefore 0.06. Now recall that the face value is going to be equal to 80 million actually. So therefore, you can simply calculate the amount of money which you can get each time in from your coupon. So you just multiply 6% by the face value. And now this is what I said. You invest or reinvest your first coupon for 2 years. You reinvest your second coupon for 1 year, and you do not reinvest your last coupon. So in total, you will get this amount of money as coupons plus interest accrued on the coupons. So coupons themselves plus reinvested coupons. So do you understand this? Because now we're going to move further. So do you understand this part of calculation? Good. Now, now we need to, we're still at this period, so we still don't move to 3.7 years. We're still at this nice number, which is just equals to 3 years from now. So that's what we get from our coupons. But in addition to our coupon, we will also has the price of the bonds itself. So we have coupons reinvestments on the coupons, but also we have the price of the bond itself. So ideally, we would like to calculate the price of the bonds as of the 3.7 years, but let's first calculate it as of 3 years from now. Again, that will be just easier. So we already know that all our coupons together with the interest accrued on the coupons will give us this amount of money in 3.7 years. Now let's see what will be the price of the bonds 3 years from now. So we know that 3 years from now, and we have 4-year coupon bonds, so 4 years time to maturity equal to 4 years. So we know that 3 years from now, our bond will have 1 more year to maturity. Therefore, so at time to maturity, it will give you this face value. So again, this is this face value. So this is the total what we'll get as a face value. So 4 years from now, it will give us this face value. But also do not forget that there will be 1 more last coupon 4 years from now. So which can be calculated like that. So when at time to maturity, when 4 is equal to when t is equal to 4 years, we will get the last coupon and we will get the face value. But 3 years from now, we will get less because we actually need to discount this by 1 year periods. So we discount 4-year terminal value to the 3-year present value. So this is gonna be in total. This is gonna be the present value of our bonds 3 years from now. So again, we discount simply, okay, you can actually write it like that. We raise to power to 1, and then we get this amount of money. So tell me, please, do you understand this part of the calculation? So let me switch it on once again. I wonder where I have it. This one, I guess. So you mean this one? Okay, because the first coupon, the one, so we count everything relative to 3 years. So what amounts of money we will get by 3 years from now. So the first coupon will be received 1 year from now, and you will be able to invest it for 2-year periods, for this period and for this period. So therefore, we raise to power 2. So we simply, well, we calculate, how many interest will be accrued over 2 years. Then the second coupon will be obtained 2 years from now, and relative to 3 years from now, there will be only 1 period left. So this one. And therefore, you will be able to invest only for 1 period. So you calculate interest accrued over 1 period. Then relative to 3 years from now, you will also get 1 last coupon here. So actually the last coupon will occur 4 years from now, but we don't count this because we want to understand how much money from coupons and coupon reinvestments we will get 3 years from now. Therefore, the last coupon will be received 3 years from now, and you won't be able to reinvest it at all. That is, this is just the coupon itself without any reinvestments, because there will be no time for reinvestments. So do you understand it? Okay. So, and as for the second parts, in the second part, so in the first parts here, we deal with the value of our coupons. relative to 3 years from now. And in this part, we deal with the value of the well, the face value, the price. So this is the what to say in Russian. It's тел облигации. So we deal with this face value relative to 3 years from now. So do you understand this part? Okay, looks like you'll understand it. Okay, it's really important that you should understand it, because the other calculations will be just in the same manner. So you only need to understand this this kind of calculations only. So this is our gain from coupons and coupon reinvestments. So this is what we'll get from the face value of the coupon bonds, and now we take it all together here. And now what we'll need to do, since we are going to hold the bonds for 0.7 years more, we simply bring this amount of money to the future value as of 3.7 years from now. So we simply need to raise it to this power. So we use the same interest rates, 5.5%. We assume that interest rates do not change. And then if you do this additional calculation, if you bring the value of your bonds investments as of the 3.7 years from now, then you come precisely to 100 million, okay, let's be dollars. So indeed, we see that if now we invest, where is it? So if now you invest this amount of money into your bonds portfolio, or which is equivalent if now you buy this quantity of bonds into your bonds portfolio, that's indeed under the assumption that interest rates remain 5.5%. At the 3.7 years, you will get precisely 100 million. Well, this is okay, but let's see what will happen if interest rates changes. If interest rates goes up to 5% from 5.5, or they go if they go actually down to 5%, or if they go up to 6%. So in this case, we already know that our portfolio will be immune, because we set Macaulay duration, this one, to be equal to 3.7 years. So we know that at the end, we will still get the same 100 million, but let's just make sure that indeed that's what we'll get at the end of the holding periods. So we're going to perform the same set of calculations, but now we're going to use other interest rates. So assume that interest rates actually fall to 5%. And so we have a drop in interest rates from 5.5% to 5%. Now we conduct the same calculation, but we use another interest rates. So first of all, we conduct the value of coupons and reinvestments on coupons as of 3 years from now. So we use the same formula as here, but now we substitute another interest rate. So we make an assumption that a change in interest rate occurs right after we form a portfolio. The very first coupon is already reinvested at 5% interest rates. So we use 0.5 here instead of 0.55. And therefore, as a total, you will get something like that. So let's compare. Here we had 15.34, and here we have 15.26. So we actually we do not have enough gain on coupon reinvestments. That is, interest rates drop, and therefore we cannot reinvest at the same higher interest rate. So our gain on reinvestment is smaller now. So if compared to this one, it is smaller. But let's see what happens to the face value of the bonds as of the 3 years from now. We do the same. So we calculate the last coupon, we calculate the face value, and then we discount as if we are 3 years from now. But now we use another discounting rate, so 0.5 instead of 0.55. And we see that actually our selling price, if, for example, we would sell 3 years from now, then our selling price is this one, which is actually larger than this one. Here we have 81.10, and here we have 81.48. Therefore, interest rates go down, we lose on coupon reinvestments, but we gain on a change in the price, because if interest rates go down, bonds price goes up. Now we do the same. We combine our value from coupon reinvestments, our value from the bonds itself, and we bring it to the future value as of 3.7 years from now. So just by adding these parts. And then as a result, we again come to 100 million. So as you can see, even though we have different values here and here, we still come to 100 million, even though interest rates have changed. Therefore, we have this balance. Our decrease in the value of coupon reinvestments is compensated by an increase in the bonds price, in the bonds selling price. So we have stricken a balance. And now let's see what will happen if instead of drop to 5%, we have a rise to 6%. So again, we calculate, first of all, our coupon reinvestments, so the effects of our investments of coupons. Now, since interest rates go up by 6%, we can reinvest at 6% interest rates. Therefore, we have this amount of money. So if we compare it to the original investments environment, so in our original way, in our original environments, we have 15.34, and we reinvest by at 5.5%. Now we have more, actually. We have 15.42 because we're able to invest at high interest rates. So we have an increase in value of coupon reinvestments. However, if we calculate the selling price as of 3 years from now from the bonds itself, then we have to discount by 6% interest rates, and we actually come to this amount of money, which is actually equal to our purchase price. Recall that our purchase price is 42.1335. So this is our purchase price. And actually here we have, so this is the same. No. So, actually, no, this is not the purchase price. This is the face value. So we actually come to the face value. Why so? Because we have 6% interest rates, but now our interest rates, so our new yield to maturity is equal to coupon rates, and therefore the bonds will be selling at par. So at par, meaning that at the face value, and our face value is equal to this amount. Okay, so anyway, compared to the original conditions, here the selling price is 81. Here the selling price is smaller. So as interest rates go up, the selling price goes down, and therefore we just lose on the selling price. And again, these two effects are opposites to one another. The value of coupon investments will bring the total value of the investments up, but the effects of selling price drop will bring our total value of the investments down. But if we combine these two effects together like that, and if we calculate the future value relative to 3.7 years, we again come to 100 million. So our two effects not just balance each other, they balance each other perfectly, in the sense that they precisely offset each other in such a way that at the end, we will get the same 100 million, whatever interest rates occurs in the future, whether there is a change, a positive change in interest rates or a negative change in interest rates. So something like that. As I said, this strategy is very popular, and particularly it is very popular for such organizations and financial institutions which have long-term liabilities, because over long-term periods it's much more complicated to project to make projection or to make a forecast of future short-term interest rates, whether they will go in the same way or there will be a change. So it's really difficult. As the length of time to maturity increases, then the uncertainty increases as well. Therefore, for such institutions as pension funds, insurance companies, usually these institutions have very long contracts. For example, in case of pension funds, well, not even pension funds, in case of insurance companies, if there is a life insurance, then it might have a length of, this contract might have a length of up to 50 years, for example. Therefore, it's really difficult to make any predictions about interest rate changes in the future. But insurance companies would like to get precise amounts of money 50 years from now. So how to do this? Okay, you can actually try to use this immunization strategy. So anyway, this is very popular. So tell me, please, is that clear? So do you need any further clarification about this? Okay, looks like not. This is good. Let's talk then a little bit about assumptions. So as I said at the very beginning, any strategy will work under certain assumptions. So where are my assumptions? Here. So parallel shifts and flat tom structure. So if indeed initially we have flat tom structure, and if in the future a parallel shift occurs, then our strategy will work perfectly. However, an important question is, and this question always arises, whatever strategy we discuss, whether in the stock markets or in the bonds markets, what happens if these assumptions just do not work or if we lose them? So let's see what actually might happen if these assumptions do not work. So here I decided to be more precise, and actually I decided to produce two more assumptions because, I don't know, let's be just very, very, well, very correct about this strategy. So just, like very theoretically correct. I guess if you are asked something about assumptions, I'm not sure that all interviewers might know that 4 assumptions should be observed, but it will be a good idea if you can answer that there are 4 assumptions. Flat tom structure, that's what we have already discussed. Parallel shifts, that's what we have already discussed. One-time shifts, indeed. So this is something like in our example. So interest rates either go up to 6% or they go down to 5%, and that's it. They do not change any further. That is, this change might occur somewhere meanwhile between time 0 and time 3.7 years from now, but then there will be only one change in interest rates. There will be no other changes. So one time change or one time shift. And another assumption is that we're talking actually about small shifts. So for example, here we have a small shift from 5.5% to 6%, or here we have from 5.5% to 5%. So the delta, the difference is only 0.5 percentage points, which is quite, in my view, this is quite a small shift. So under these 4 assumptions, the strategy will work just, well, the way it should work. However, let's see what will happen if one of these assumptions is, well, we lose one of these assumptions. By the way, tell me please, why do I put approximation sign here? So it seems that under original conditions, I put equality sign. So if we make investments, if we invest this amount of money into our coupon bonds, then in 3.7 years we will get precisely, well, nearly precisely actually, 100 million, but here I strictly put approximation sign. So when we look at how interest rate deviates, I put the approximation sign, not the equality sign. Why so? So why don't I don't write something like that? Okay, so I guess you cannot answer this question. Well, but this is this question actually just relates to these small shifts, because recall that the strategy itself is based on the duration, and recall that duration it's it's about the change, the size of the change in interest rates. So I don't actually quite understand this question. Sorry. Okay, let me just continue. So the immunization is based on the duration, and recall that duration actually shows you the change in the bond's price with respect to a theoretical infinitesimally small change in the bond's yields. In finance, we do not say infinitesimally small because that doesn't make any sense. But still, we assume that that's going to be a small change. However, we don't really know whether there's going to be a small change or not, and therefore, and this is the first reason. And the second is, but actually that's, well, what can add in precision here? So this is just duration-based estimates. We base our change only on duration, but recall that actually there's something which is called convexity, and if we add convexity, then our estimation would be more precise. But just no one uses convexity for the case of immunization. At least I don't know such cases, because that would be more complicated. Anyway, small shifts. So let's see what happens if we lose one of the assumptions. And right now, all these assumptions work well. So I do not lose any of this assumption. And then what I did, I simply modeled in Excel different situations. So we have 5%, 6%, and as a basis, we have 5.5%. In this case, and we have 3.7 years from now. So as you can see, even if a change in interest rates occurs either to 5% or 6%, it's only in the beginning that the value of the portfolio will change. But if we wait for 3.7 years, then these values will converge to the same 100 million. So at the end of the holding periods, we precisely come to this terminal value. That's what we want. So really don't care much about all these changes, because our immunization strategy just works well. Now let's gradually shift one of these assumptions. And I'm going to shift this assumption, small shifts, and let's assume that instead of a very small shift in the interest rates, we have one-time big shifts. So let's see what I have as a model, as a result of the modeling. So again, this is our initial interest rates, 5.5%. this is interest rates from our example, a drop to 5% or a rise to 6%. And now I model two additional changes in interest rates, 3%, that is from 5.5 to 3, which is still kind of small change. But then I model a bigger change from 5.5% to 25%, which is really a huge change, a huge unexpected change in the price. So if we are talking about this 3% change, then we are somewhere here, right? So the value of the portfolio first actually increases at the beginning of the strategy. The value of the portfolio increases compared to the original value simply because a drop in interest rates means that the selling price rises a lot. However, over time, this rise in the price becomes less visible because you are not reinvest your coupons at the same interest rates. And finally, in 3.7 years, the total benefits from this actually becomes at the same level as the benefits from other changes in interest rates, like small changes in interest rate like that. So we still come to this 100 million. So it's not really clear, but I believe that we still have this kind of interception, points of interception here. So a change to 3% will give us approximately the same 100 million in 3.7 years. But if there is an increase in interest rates up to 25%, then this is our line. Additionally, our value of our investments decreases a lot because the selling price decreases a lot, but you are able to invest coupons at a very high interest rates, at 25% interest rates. And this reinvestment effects actually not only compensates a drop in the price, in the selling price, but actually it surpasses this negative effects. And as a result, in 3.7 years, you will obtain much more than 100. Well, not much more, but still you will obtain more than 100. I don't know how much is it here, but probably it's something about 1 million and I don't know, 1 million and probably 102 million, etc., something like that. Okay, so in this case, what we can say, what can we say if we use a professional language? We would say that your liability, and recall that your company has a liability equal to 100 million in 3.7 years. In this case, we will say that your liability is overfunded. You as a result, you obtain additional funds, so your liability is overfunded. But it's only because there is a huge increase in interest rates. If we had an opposite situation, a huge decrease in interest rates, then your liability would be underfunded. Okay, so we discussed this. Let's see what happens if we lose another assumption. So now we lose one-time shift. Assume that interest rates actually undergo two changes within the holding period. So once and then one more times. So this is what I have as a result of modeling. So this time again, originally we have 5.5% interest rate, which is unchanged, and this is our straight line, this one. So I guess you can see it. I will not, well, draw it once again. And now we have two versions. Originally, interest rates either drops to 5% or 6%, as in our example, but then I add one more change. So one more drop, further drop to 2% or further drop to 8%, further rise to 8%. And then a kind of extreme case, by the way, I didn't probably say, but this is also a very extreme case. If interest rate is equal to 5.5%, then the situation that within a holding period, quite short, 3.7 years, it is a quite short holding period. So the situation, the probability that interest rates will drop to 25%, will rise to 25%, the probability for this event is extremely small. This is this is practically impossible. That is, even though this situation shows you that you will be overfunded, but practically, well, you will not see this. This is just impossible to see such a huge change in interest rates. So this example is also very extreme, but still, let's consider this. Interest rates first go up by 15% and then additional change to 30%. I don't know, that should be probably something like, you know, hyperinflation, something like in Latin American countries. I don't know what's a real example can suit this situation. So in this case, what we have, so this is our first change. So and this is our second structural break, I would say. So again, this is also our structural break. But as you can see, now if we are 3.7 years from now, so I would say that, well, we will be approximately at the same amount of money. Well, probably not strictly 100, because you can see, if you try hard, you can see that we are not precisely at 100. There will be a little bit of difference, but still, I wouldn't say, but this is all, this is that much critical. So like that. So probably a two-time shift does not matter as much as a small shift. So we can allow for two-time shift, but it's still a better, well, so this is a safer to assume that there is a two-time shift, then there is a safer to assume that there is a bigger shift, because in this case, we'll definitely come to overfunding or underfunding. And here it's there will be a discrepancy. Obviously, it's undoubtedly there is a discrepancy, but it's not that much. So let's see what if I lose some other assumption. I guess this one, the parallel shifts. Okay, parallel shifts. So once again, so for example, this is our original yield curve, and then the parallel shifts will be like that if there is a parallel shifts up, or like that if there is a parallel shift down. But now we assume that it might go like that. For example, at the short ends there is a drop, at the long ends there is an increase, a rise. So this is a non-parallel shift. So let's see. So I guess we need to look only at this part, because here I assume that the shift is non-parallel. It actually goes like that. So this is an ascending yield curve. So instead of this yield curve, we get another yield curve next time in the future, which is not flat anymore. This time this yield curve is an ascending type, or has an ascending shape. Well, let's look. So in this case, if the shift is non-parallel, then we are overfunded again. In 3.7 years, we attain more money than we need, so the terminal value will be more than 100 million. But again, it's all that it's really good if we are overfunded, but it's only because I assume an ascending non-parallel shift. But if I, for example, assume a descending non-parallel shift, then well, there will be an underfund, the liability will be underfunded. So anyway, this is not really good. So, and the last part is flat sum structure. This is the most, so these assumptions, as you can see, some of these assumptions we can lose some of these assumptions quite safely. However, the major assumption is actually about flat sum structure, that is, you know, this one, because the major question is, we really don't observe the flat sum structure frequently. Actually, if you recall from the previous home assignments, I ask you to find flat term structure in the Russian coupon bonds markets, in the treasury, well, in OFZ markets, and I don't remember, but probably you did not find a really good representation of the flat term structure. So the major question is, most frequently we actually observe a positively sloped or normal shape of the yield curve. So it's just like that. So what happens to the strategy if we try to implement it under the normal conditions of the ascending or positively sloped yield curve? So this is our yield scale, yield axis, and this is our term to maturity axis. So let's see what will happen in this case. So there is no change. So here I assume a kind of ascending, here I assume a non-flat term structure. Actually, I had to prepare it in Excel, and therefore for me it was more convenient for this particular example to use 3 years as time as the end of the holding period. So previously I was able to cope with the 3.7 years, but for this particular to lose this particular assumption, in order to make calculations more convenient, I have to assume that we hold our bonds for 3 years, not for 3.7 years. Anyway, so what happens in this case? So there is an ascending term structure, and I assume some ascending term structure, just some abstract ascending term structure, and then I assume that there's either no change or there will be also a shift, either 10 percentage points or minus 10 percentage points. So what we see, in all the cases we do not achieve 100 million, so we will be overfunded in all the cases. So obviously if I assume a descending term structure, or actually we call it inverse yield curve, then there will be then our liability will be underfunded. So anyway, all examples here seems to produce overfunded liability, but it's only because it's just like that. Do not be confused by this, in a sense that this is good, but if interest rates actually go down, then there will be a bad effects. So anyway, in this particular case, we are overfunded and we do not achieve this precision. So we would like to get 100 million, but we won't get it. So unfortunately, like that, it does not mean that this strategy is not used. As I said, it is quite widely used, even though the most frequently the term structure is not flat. Most frequently it is either upward sloping or downward sloping, but still the immunization strategy works because at least it can help you somehow. It still can help you compared to the no strategy at all. So at least even if you won't be able to lock in 100 million, you will still lock in the sum which is close to 100 million, and it's still better than to have a totally different terminal value at the end of the investment period. But you might ask me, do we have better tools to deal with this immunization? That is, are there any strategies, well, other types of immunization strategy which will help us to perform, to get a more precise terminal value at the end of the holding periods? Well, there are. However, these strategies are more complicated and they are beyond the scope of this course. However, I can actually give you a reference if you want to study this yourself. I'm not sure if you have Veronese, because Veronese, I'm not sure if Veronese is Veronese. So this is a textbook edited by Veronese, and you need to search for chapter 7. So in chapter 7, he describes two different types of duration, which is based on the two types of immunization, and they are actually based on duration which is derived based on the principal components analysis. So as I said, it's a little bit more complicated, but if you believe that you're going to work in the bonds, in the fixed income department, then you probably should know this. So try to find Veronese and the chapter, the 7th chapter. If you cannot, and if you still want to read it, let me know and I will send it to you, because overall, as far as I said, I just cannot send you the whole book. This is, well, there will be a breach of, I don't know, the breach of rule, but I think I can send you chapter 7, but just if you believe that you need it, I will send it to you. Well, let me see how much time we have right now. Okay, 2 more minutes left, so there's definitely no sense in starting this new topic. So well, we will start this next module. So that's it for today. Mind it that we are going to have only tutorials for the rest of the module. And well, first of all, I'll ask you if you have any questions, and then I will make an announcement. So do you have any questions concerning this lecture? Well, I do not have the whole book, because actually it's just well, it's not given, you cannot get a free access for this book, and I don't feel that you have it in the library, but I can send chapter 7. I just do not have the whole book. Okay. Okay, I think I can send chapter 7 to your email. I don't feel that it's too big to be uploaded, but I'll see. So no questions. Okay. Then an important announcement. As you see, so we have lecture today instead of Friday, and then we will not have anything on Friday. I mean, you will have something, but not with me. And therefore, we will going to have our next tutorial nearly 2 weeks from now. So well, not precisely 2 weeks, but nearly 2 weeks. And this is a good opportunity for you to take the home assignments and to solve the home assignments, which I'm going to grade. So the next home assignments will be the one which I will grade. I remind you that that will be the only one home assignments which I will grade, and whose grades will constitute 40% in the definitive grades for the course. So these home assignments will be sent to you tomorrow together with the lecture notes, and these home assignments will be from, will cover several lectures. That is not just one particular lecture, but several lectures, so it will be a kind of comprehensive relative to the material, relative to the topics which you have already learned. So something like that. I will make a formal announcement tomorrow in my message to you, and in this message, in this email, I will write precisely the rules for deadline, for the submission, and other details like that. So this is my announcement. Well, now tell me if you have any further questions. Okay, you seem to have no further questions. Okay, then we can stop here, quite on time. So tomorrow I will send you, yes, something like you already have had before. So numeric problems which you need to solve. No, not essay. I have no idea how to grade essay. It seems to be so subjective. So I prefer to be very formal and more objective, in the sense that if I see that numeric problem is solved correctly, then you will get a grade. If not, then you will not get a grade. So this seems to be just more correct. I don't like grading essays. So let's finish right now. And so what I can say, I wish you good luck in your home assignments. So do not forget that will be the one which is going to be graded. See you next week. Have a nice week and goodbye.